Okay, let's unpack this. We have to start with what might be one of the most puzzling financial stories of the last decade.
Absolutely.
Bitcoin's entire journey in 2025.
Right.
I mean, the story arc was just textbook perfect for a historic run.
It had everything going.
Everything. Massive historic highs reached just last month in October. You had celebrations, headlines screaming, the $100 K barrier broken. And then
a complete reversal.
a breathtaking reversal. The currency ends the year pretty much exactly where it began, wiping out every single penny of its annual growth.
It really is the ultimate paradox, and our mission in this deep dive is to figure out, how does the math even work on that? How do you have arguably the most favorable news cycle, the best regulatory environment the sector has ever seen, hit an all-time high, and then just hit a reset button?
Fall all the way back to your January 1st valuation. It defies what every major analyst was expecting.
Every single one.
And the numbers are so shocking in just how precise this reversal was. To really establish the scale of this collapse, let's look at the start and the end.
Yeah, let's lay it out.
Bitcoin starts the year, January 1st, 2025, at $93,507.
Right, 93,507. That was the starting line. Now look at the bottom of this recent, pretty brutal drop. The price fell to $93,029.
So you're talking about an entire year of gains just gone. The price settles fractionally below where it started.
And that sharp reversal, that meant shedding, what, 25% of its value from that October peak?
A 25% drop. So here's where it gets really interesting. 'Cause the first question you have to answer is, why was everyone so convinced this was going to be the year? What was the perfect setup?
Well, we can really point to a confluence of three major factors that made 2025 seem, almost bulletproof.
Okay.
You had institutional access, corporate trust, and really fundamentally, a political tailwind. And that's where we should probably begin.
The politics.
Yeah. The inauguration of the Trump administration on January 20th, it was widely seen as signaling the most crypto-friendly regulatory shift ever.
I remember that. The consensus was that this administration didn't just talk a good game, they actually followed through.
They did. For years, the market had been operating in what analysts always called a dark room. Just this massive barrier of regulatory uncertainty.
And big institutional money hates uncertainty.
Hates it. So the perception was that the new administration was turning on the lights, providing clearer rules. Imperfect, maybe, but clearer. And that signaled massive confidence.
So how quickly did that external confidence translate into, actual balance sheet investment? Because that leads right into your second factor, corporate treasury adoption.
It translated very quickly.
Yeah.
Because that regulatory clarity, it just lowers the perceived risk.
Of course.
And so suddenly, corporations started treating Bitcoin not as some speculative gamble, but as a real foundational reserve asset.
Like digital gold.
Exactly. Digital gold. A hedge against inflation, a hedge against dollar instability. That signals a profound structural shift in trust.
And then the third factor, which is just impossible to overstate, was the ease of access through ETFs.
Absolutely. The spot Bitcoin ETFs, they completely demolished the complexity barrier.
Right.
So you have millions of traditional investors, pension funds, retirement accounts, just everyday people who were maybe scared of crypto wallets and all that complexity. Now they could get involved easily, right through their normal stockbroker. So these three forces coming together, it should have been unstoppable.
But it wasn't. Instead of that steady momentum, we got the reset button. So the central paradox is, why did the price suffer with all this overwhelming support?
It was a double punch.
A double punch. Okay, so let's look at the external factor first.
The external factor was macro instability. And ironically, it links right back to that political environment we just talked about.
How so?
The market was destabilized by trade wars, rising interest rates, and crucially, the record-long U.S. government shutdown.
The 43-day shutdown
Right.
that had just ended the week before this final collapse.
Exactly. And a shutdown like that, it creates extreme systemic risk.
Can you just paint a picture of why that level of political paralysis matters so much to global markets, even for an asset like Bitcoin that's supposed to be separate?
Well, think about the mood, just the mood across the U.S. economy during that month and a half.
Total chaos.
Total chaos. Millions not getting paid, critical services stalled. The very idea of governance is in question. And that kind of shock forces even sophisticated investors into pure risk aversion.
So they sell.
They sell off anything they categorize as a risky asset, and they just hold cash as a flight to safety. And even with all the corporate adoption, Bitcoin is still seen by big players as a volatile growth asset.
So the shutdown was like a giant risk siren going
A
off.
massive risk siren.
Yeah.
And it caused multiple double-digit dips all year as institutions had to liquidate.
So that macro punch was a huge deal, but you said it was compounded by an internal factor, the whale effect.
The whale effect.
For anyone who might have forgotten the jargon, who are the whales?
So whales are the original holders, the OGs, people who acquired vast amounts of Bitcoin very, very early on.
When it was worth single digits or low hundreds.
Exactly. So they're sitting on these enormous fortunes, and their movements when they sell, when they take profits, can swing the entire market in a way that even institutional buying can't fully counteract yet.
And the fear narrative that took over in the fall was that these OGs were just dumping their bags, abandoning the market.
And that drove a lot of retail panic, for sure. Panic is always a powerful market force.
But what's fascinating is the data analysis that came out from firms like Glassnode.
Right. And they confirmed it. They confirmed the increased selling pressure from these long-term holders. The whales were selling in large volumes.
But, and this is the key part, Glassnode called it normal bull market behavior, not a panic sell.
Their interpretation was that it was a controlled distribution of profits, which, makes sense. If you bought something for $100 and now it's trading near 100,000, taking profits is rational.
But doesn't that raise a really important question? If institutional adoption and regulatory clarity are supposed to bring maturity and stability, why is the biggest source of volatility still this small group of original holders just taking profits?
That is a powerful challenge to the maturity narrative.
The fact that sustained whale selling was enough to cancel out billions in new ETF inflows, it suggests the market isn't as structurally deep as we thought, right?
Precisely. It implies that the price, at the end of the day, still rests on the whims of a few dozen fortunes, not this broad institutional base we keep talking about.
So whether it was panic or just rational profit-taking, the result was the same.
The result was the same. This sustained heavy selling pressure from large holders, it just prevented the price from finding new, higher support levels. It put a heavy ceiling on every rally and contributed fundamentally to the final collapse.
And the pain wasn't just in Bitcoin, this was market contagion. It spread across the whole ecosystem as fear just blanketed everything.
Oh, the altcoin pain was severe. You look at Ether, the second largest currency. Since the start of 2025, it's down almost 8%.
8%, and that's considered one of the safer ones?
Exactly. The real damage was in the higher risk assets. Solana, for example, dropped a staggering 28.3% in the same period.
Wow.
When you see drops like that across the board, it confirms that it was generalized risk aversion. It wasn't just a Bitcoin-specific problem.
And this whole collapse, wiping out a year of growth, despite all the supposed maturity factors, it forces us to ask the biggest philosophical question in the industry right now.
Has the 4-year cycle been permanently broken?
Exactly.
And this is a crucial debate, because historically, Bitcoin's price has followed this reliable pattern linked to the halving event.
Right. For anyone who needs a quick refresher, the halving is this internal technical event. It happens about every 4 years, and it cuts the reward that miners get for validating transactions in half.
And why does that matter so much?
Because it tightens the supply of new Bitcoin instantly.
Exactly. And so historically, the theory dictates that this supply restriction acts as a forced deflationary catalyst. It drives the famous price boom, which is then followed by a crypto winter and then recovery into the next cycle.
But the dilemma is just staring us in the face. We had the halving, we had the institutions, we had clear regulations, and yet the crash happened anyway. It nullified the entire year's growth.
So has the old model, which was driven by internal supply mechanics, just been permanently broken?
That's the question.
And a lot of sophisticated analysts are starting to say, yes, it has. They argue that the sheer weight of global macroeconomics, the government shutdowns, trade wars, global risk, and the sustained volume from institutional trading, it all now simply outweighs Bitcoin's internal supply schedule.
So it's too big now, too connected.
It's too big, too institutional, and too connected to global liquidity to be dictated just by a technical supply event. It's moving to the tune of global risk appetite now.
Okay, so that paints a pretty grim picture of external control. But there is always a counter-narrative, and we have to focus on what happens next.
Right.
Matt Hogan, the CIO of Bitwise, he's staying extremely optimistic. He's predicting a massive boom in 2026.
He views the current price action as a discount trade, which is a fascinating way to frame
A
it.
discount trade. What does he mean by that?
His core argument is that the fundamentals, so the underlying technology, the real-world adoption, are strengthening exponentially, even as the short-term price is falling because of macro fear.
So he's saying smart money is ignoring the volatility.
That's the argument, but you have to ask the right question, which is, why should we trust that optimism now? All the political and institutional tailwinds we just described, they failed to prevent a crash back to zero.
So can technological potential really overcome that kind of persistent macro fear?
That's the bet he's making. His argument rests on this long-term tectonic shift being built underneath the price chart. He points to 3 technological pillars that he believes are just too big to fail.
Okay, let's detail those pillars for the learner.
First, you have stablecoins. These are the cryptocurrencies pegged to an asset like the US dollar. They're becoming a faster, cheaper, global payment system.
Right, replacing old wire transfers.
Rapidly. Second is tokenization. This is the process of turning real-world illiquid assets like a property deed or a share of stock or fine art into digital tokens on a blockchain.
And that massively increases liquidity and access for everyone?
Everyone. And finally, the goal that started it all. Decentralized finance.
DeFi.
Yes. The third pillar, building a completely new global financial system, lending, borrowing, trading, insurance, that all operates transparently without traditional banks.
So his message is basically, start watching the daily price chaos, look at the revolution being built.
That's it. That value accumulation is happening independent of the price.
So, okay, what does this all mean for the person listening right now? We saw this unprecedented political support, corporate adoption, institutional access, but all of it got canceled out by government instability and whales taking profits.
Price went up 25%, then came right back down 25%.
A round trip to nowhere.
The key takeaway for you, the learner, has to be the critical distinction between price and value.
Price versus value.
Exactly. The price of Bitcoin, it's driven by fear, greed, macro instability. It's clearly volatile. It crashed back to zero growth for 2025. But the value of the underlying technology, the DeFi, the stablecoins, the tokenization, that is still being developed and adopted worldwide.
And that's the core insight here, isn't it?
It is. I mean, think of a startup. It triples its user base, launches 3 amazing new products, hires 50 world-class engineers.
Right.
But its stock price dips 20% just because the broader market is in a recession.
Right. The company got better, but the price went down.
The value and the potential are growing, even if the price is temporarily suppressed by external risk. And separating those two concepts is critical, not just for investing, but for assessing any volatile market or endeavor.
And this whole discussion about the breaking of the 4-year cycle, it leaves us with one final provocative thought for everyone to chew on. If massive external macro events like a US government shutdown now definitively outweigh Bitcoin's predictable internal supply mechanics, what does that truly mean for Bitcoin's identity going forward?
That's the real question.
Is it still this revolutionary insulated asset, digital gold separate from the system? Or has it just achieved a final painful integration, becoming another highly volatile, macro-sensitive tech stock? What stands out to you?
And that decision, where it sits on that spectrum, is going to be the defining question for the next cycle.
Thank you for joining us for this deep dive. We'll catch you on the next one.